Okay, good afternoon again, students. So now, I think we better go through the short quiz just now that you have attended before the lunch break. And then thereafter, we are going to look at one more exercise before we go into second part of the financial instrument. Okay, let me just share the screen first. Let me check recording. Okay. So over here, of course, the first question is your details. Who is it that is attempting the quiz? And then over here is the first question, which is the question number 2 in this particular quiz. Okay, so what do we have? The question asks you about which of the following is not a financial asset and also not a financial liability. Okay, so can't really see all of it. Of the 10 of you, there's only one student who said that equity instrument of another entity. Equity instrument of another entity basically is what? Part of your financial asset, because it's like, you invest in the equity instrument of another entity. So you have investments in shares of another entity. So that one could be part of your financial asset. Cash, of course, we know that it is financial asset, but prepaid expenses, as mentioned earlier, is not part of financial assets, although it is part of asset in a SOFP. The reason is because when you have prepaid insurance, it does not give you any contractual right to receive cash anymore. Okay, it just gives you the right to receive the goods or the right to receive the services. So which means that it does not fulfill the definition of the financial asset. Okay, so we will say that, yeah, prepaid expenses, although it is part of your current asset in the SOFP, it is not part of the financial asset. Then the next question, what is the principle of accounting for convertible loan instrument? Okay, so of course, this one probably, I think I shouldn't open this because I can't see everything. Maybe I should just open up my forms. Short quiz. Okay. Yeah, I think it's easier here. Okay, but I wouldn't be able to see what's the score like, right? Okay, so this one is, most of you answer it correctly, yeah? So let me just see. What is the principle of accounting for a convertible loan instrument? So just now we have looked at RIMBA, we have looked at Carai's cost, and basically for convertible loan instrument, since we know that there is this element of convertible into what? Into ordinary shares. So this means that it is a hybrid instrument or a compound instrument. So when we want to record it in the books, we have to split between the liability components and the equity components. Okay, so we need to separate. So it's correct. We need to separate. But how do we separate them? We are supposed to calculate the fair value of the liability component, which means the present value of the principal plus with the present value of the interest components. Okay, and the residual will be the equity component. So this is what we have been doing. And then if you want to put it down into a sentence, this will probably be able to explain what we have been doing when we did the compound instrument split accounting. Then the next question is, remember when we did the compound instrument, we also talk about coupon rate, we also talk about the effective interest rate. So effective interest rate, in other words, what is the correct definition? So let us see for this one. Yeah, almost all answered correctly. So this one, effective interest rate. I think another way to explain about this effective interest rate would be like, when you were in your undergraduate studies, I'm sure you have taken some finance paper. So this will be equivalent to what we always say, internal rate of return, the IRR. So which means effective interest rate is the rate that exactly discounts estimated future cash flows or receipts over the life of the instrument to the carrying amount. So basically, IRR is when NPV equals to 0. Okay, so basically that is the definition for the effective interest rate. And then the last one, dividends paid on redeemable preference shares are what? Basically we say what? If you have redeemable preference shares is part of your financial liability, okay? Or it is part of your non-current liabilities. So when you pay dividends based on the redeemable preference shares, even though it is called dividends, it will still be charged out in the SOPL as part of the finance cost. So it will be charged as expenses in the SOPL. Okay? Yeah, I think over here, it is never deducted from equity because it is a dividends on redeemable preference shares. If it's a dividend on ordinary shares, yes, you are going to deduct it from the retained earnings, but not from equity, yeah? The last one is what? What's the last option? Oh, charge as expenses in the OCI. No, because it's either we deduct it from the SOCIE, which is the normal dividends on the ordinary shares, or we will capture it as part of the finance cost. Okay, so which means that we have already discussed this. And if I were to close off this, what was the average score? 3.2 out of, I think, 4 marks, because there's only 4 questions. So still okay, not too bad. All right. So this is the short quiz just now. So we just close this off. What I want to look at now is earlier, just before the break, I have already put down the under the files section under class number 9. The financial instrument with respect to Palemo's illustration, and then the Rimba's one. Okay, so I already put it under class number 9. So now we want to do another one, which is classification of the financial instrument, the exercise that I have sent to you earlier. Okay, so this is on Argosy. Just check whether I have sent to you. I think I did, Let me just check as well. This is the one. Yeah. H4A. Okay. Close this tab. Okay. So you can see from here, this is another exercise that we are supposed to go through. And then over here, this is more of classification. So of course, the classification means what? Is it supposed to be a financial asset, financial liability, or equity instrument? So for you to be able to discuss the classification of the respective scenarios correctly, so which means classification will be either financial asset, financial liability, or equity instrument. Then the accounting treatment Of course, the accounting treatment will depend on what kind of classification that has been so-called specified. Okay, and of course, they will always tell you, in accordance to the relevant accounting standards. So as we can see over here, of course, we just have completed the classification of the financial instrument notes. So which means that, of course, here it will be in line with your IAS 32 classification. So bear in mind that although we may have certain quite a standardized kind of classification, once we look at it, we know. But sometimes there could be scenarios like what you are seeing here that is a little bit peculiar. And because of the peculiarities, you will find that they probably do not qualify the norm classification. Okay, so we just have a quick look here. So since we know that the question is on classification of the financial instrument, and then we are supposed to have accounting treatment. Question verb, discuss. So all the time when we attempt questions, the first thing that we should look at is basically the requirement, as I mentioned many times before. So look at the requirements of the question, then only we go and look at the situations given to us. Okay, so question verb, what is it that you're supposed to be looking at? What is it that you're required to do? Okay, so now that we have done that, we can go and look at Roman 1. So what do we have here? They gave you transactions that has taken place in Agosti in the current financial year, ending 31st December 2019. So which means this is the year end. Okay. Then what do we have in scenario number 1? Agosti issued 50 million non-redeemable preference shares. So just now the quiz question, we talk about RPS. RPS is a redeemable preference share. Redeemable preference shares, as we have mentioned just now, falls under non-current liability. Okay, non-current liability in the SOFP. And then over here, this is non-redeemable preference share, which means it's just preference shares. Okay, so 50 million of it, worth 50 million, $50 million. Under the terms attached to the non-redeemable preference shares, a dividend is payable on the non-redeemable preference shares only if Agosti also pays a dividend on its ordinary shares relating to the same period. Okay, so basically, as what we know, if we have preference shares is just part of equity. But this particular preference shares, let's say if you have certain percentage, some XX percentage written in front, that means you are supposed to pay this question mark percentage. Maybe we don't put question mark. Let's say if I were to put like 8%, okay, 8% preference shares. So which means that the 8% will indicate the dividends. But if we have a 8% dividends on the preference shares, which means what? The 8% preference shares is fixed. In other words, you cannot not pay. You must pay because it's a commitment to pay. Okay? So this 50 million numbers of preference shares is worth $50 million. That means the preference share capital is 50 million. But the condition here is a little bit different from the norm that we know. They tell you that, oh, this particular percentage, as indicated on the preference shares, will only be paid only if the ordinary shares are paid their dividends. So in other words, if the ordinary shares are not paid the dividends, then the preference shares cannot get. You understand what I mean not? So let's say if Argosy has no intention of paying the dividends on these preference shares, the most they can do is don't pay their ordinary shareholders. Then they don't have to pay the dividends. Okay, so under such circumstances, the question is, how should we classify this particular non-redeemable preference shares in our books? So of course, looks like only got two kinds. It's either financial liability or it is an equity component. Okay, so this one should be either FA or equity. Sorry, not FA, financial liability. Because it's not an asset, it's either a financial liability or equity. Okay, so we will come back to this. And basically, how do we distinguish? Of course, we will always have to go back to the definition. The second one, we just look at it first, then we come back and see what kind of classification should we award to each of those scenarios. The second one, Argosy entered into a contract with a supplier to buy a significant item of equipment. So which means that they are going to buy non-current asset with a supplier. So under the terms of the agreement, supplier will receive ordinary shares with an equivalent of 15 million in 1 year's time after the equipment is delivered. Okay, so which means what? If you have done this too, which I think that is not yet covered, IFRS 2 basically is on share-based payment. Share-based payment means what? Sometimes you can buy certain goods, or you can pay your what do you call that, employees or your suppliers in the form of shares of your company. So that's why we say share-based payment. Of course, under share-based payment, we have equity settled share-based payment, we have cash settled share-based payment, and we also have a choice of the both. Okay, choice of the two lah. All right. So under share-based payment, it will be something like what we can see here. When you enter into a contract with a supplier to buy some goods or some asset, you are going to pay them in ordinary shares. Okay, that means you don't pay them cash, but you say, oh, wait, I'm going to pay you in the form of shares of my company. Can this be done? Can. But then the thing here is that the payment will be equivalent, will be paid in the ordinary shares with an equivalent value of 15 million, and it will be paid 1 year after the equipment was delivered. So which means that you don't need to pay now, but you pay 1 year later. Today you get hold of your equipment, but you pay 1 year later, and when you pay that time, the ordinary shares that the supplier will receive will be equivalent to $15 million. Okay, got that? So looks like IFRS 2, but actually IFRS 2 is slightly different, because in terms of IFRS 2 share-based payment, we already say, yes, we can buy the assets, we can buy the goods and pay in the form of shares. But in IFRS 2, the numbers of shares is fixed. Number of shares is fixed. Fixed. What is variable will be the value of the shares. Okay, because numbers of shares, whatever XX number of shares, then you need to times by the share price to get to the value. Okay, that is in line with IFRS 2. But over here, they tell you what is fixed. The amount is fixed. The dollar value is fixed. So, which means to get to the dollar value, what will be the variable element? The variable element will be the number of shares. Because if the share price is on the upward trend, then you find that numbers of shares to make up the 15 million will be lesser and vice versa. So in this scenario, the dollar value is fixed. Numbers of shares varies, changes. Under the IFRS 2, numbers of shares is fixed, but the value of the shares times by with the fixed number of shares will vary. You understand? So this particular scenario, let's say we call scenario A, is not the same as scenario Roman 2. They are not the same. Understand? Because under IFRS 2, share-based payment, numbers of shares to be given to the supplier is fixed. How much is the value? Depends on the share price. Here, the amount is fixed. Number of share price will fluctuate. Okay, so in other words, from the discussion here, you can actually rule out IFRS 2 is not applicable in this case. Okay, but over here, we will say what? Because the payment will be paid to the supplier after 1 year after delivery. So likely is that this is just other payables to the supplier. So likely is that this will be classified under financial liabilities. Okay, then the third one. The directors of ACCA, on becoming directors, are required to invest a fixed agreed amount of money on a special class of ordinary shares. So special class of ordinary shares means that it may be different from the norm, okay? Because it's a special class. If ordinary shares, that means all ordinary shares will have the same characteristics, such that no priority of payment, dividends is not fixed, there is no maturity date, that kind of stuff that we know. Okay, and dividends, of course, will fluctuate with the performance of the company. But over here, we have a special class of ordinary shares. And this special class of ordinary shares are only made available to directors. That means if you are not a director of ACCA, you cannot buy those shares. Okay, dividend payments are discretionary. So of course we know that all ordinary shares dividends are discretionary. So that means it depends on the performance of the company. Company doing well, they will pay high dividends for the ordinary shares. Company not doing well, we probably don't get any dividends. And dividend payments are ratified at the AGM. So this is normal. You got to table it, and then the shareholders meeting, AGM, and then they have to approve that. You see the last sentence. When the director's service contract expires, so that means you no longer become directors in ACCA. ACCA is required to repurchase the shares. Required to. That means you must repurchase. Okay, so that's why they call it a special class of ordinary shares. Because in a normal ordinary shares, you don't have to repurchase because, you probably will get back your investment in the ordinary shares only when the company closes down or something like that. Okay, so the question here is that should we classify this as part of the financial liability or is it part of equity? Agree or not? Because this is the only field, of course, cannot be part of financial asset, ma. Okay, so we will now go and discuss them in more detail. Let me go to another file, yeah. So have a quick look at this. What do you call that? The suggested solution to it, huh? Okay, just give you a few minutes to have a look. Because remember the first scenario, we have the non-redeemable preference shares that their dividends will only be payable if the ordinary shares are paid their dividends. Okay, so we already say that, oh, we don't know whether this is under financial liability or is it under equity. So how do we establish that? So meaning that we have to go back and look at the definitions. Okay, we have to look back at the definitions. So what kind of definition we can provide over here? Of course, liabilities definition will be easier to provide, right? So remember, just now we say what? Could this be a financial liability or could this be part of the financial asset? So financial liability or equity. Okay, so they tell you this is on non-redeemable preference shares. And then, of course, easiest definition to look for is the financial liabilities definition. So just now in the morning, we have already mentioned about how to define or how to know that the financial instrument is classified as financial liability. If we have a contractual obligation to do what? To deliver cash or another financial asset. And then we did mention that this particular situation must be conducted under conditions that are potentially unfavorable to the entity. Correct now? Because it's either you have to pay or you have certain obligations to deliver cash. So in this case, preference shares, because they tell you they are non-redeemable. So, which means that no need to redeem back the preference shares. So, in this case, preference shares are non-redeemable, and therefore there is no obligation to repay the principal. This is based on the facts given in the case. All right. So, you see, from here up to here, basically we just copy balik from the question. Right? Because they tell non-redeemable preference shares. But how do we add value? This is the one that we add value for. Okay? Because we're tying back to whether the preference shares has fulfilled the characteristics of having a contractual obligation to deliver cash by Argosy. Okay, so we say, oh, no need to redeem one ma, because they tell you it's a non-redeemable anyway. So no obligation to repay the principal. Then now we talk about the dividends, right? The dividends. Remember just now from the facts of the case, they say you only have to pay the non-redeemable preference shares dividends only if you were to pay the ordinary shares some dividends. Okay, so in the case of dividends, because of the condition that preference dividends will only be paid if ordinary share dividends were paid in relation to the same period, the preference shareholders has no contractual right to dividend. Correct or not? Although, like I mentioned just now, although when we put 8% preference shares, suppose we say that this is a fixed commitment to pay dividends, but then they tell you, actually, you can don't pay them also, but what must you do? Just don't pay your ordinary shares any dividends. Don't pay them, you also no need to pay this 8%. So, in other words, what we are saying, you can manipulate, right? So, they tell you, in this case, the non-redeemable preference shares also has no contractual right to dividends, right? Because you just don't pay, then you don't pay them, right? So instead, the preference shares are at the discretion of the issuer, correct or not? Because what they can do, depending on what they plan to do, correct or not? They just say that, oh, if we have no intention of paying the preference shares dividends, then we just don't pay the ordinary share dividends. Very simple. So instead, the preference shares are at the discretion of the issuer because ACCA can choose whether to pay or not to pay the ordinary shares holders their dividends, and therefore the preference dividends is up to ACCA, not up to the non-redeemable preference shareholders. So in this case, there is also no contractual obligation with regards to the dividend. So you see, if we say no contractual obligation to pay to pay the dividend or to redeem the principal sum of the preference shares. So in other words, if it doesn't fulfill the liability definition, then it must be part of equity. Okay, so this is how you conclude after you have done the discussion. So of course, like I say, because time is of the essence, so which means that, you really don't have much time. You have to write whatever that will give you marks. So after you have discussed this in relation to the definitions of the financial liability, then you will have to conclude already. So as there is no contractual obligation in relation to the dividends, as well as for the principal, the definition of financial liability has not been met. And if it's not met, this one not. So the only other option is that it will be treated as part of the equity. And you know that equity instrument, initial recognition, will also be at fair value. Fair value means what? How much is it that you have issued out to the market? So in this case, 50 million. Understand? So always remember, you have to agak-agak what the scenario is first before you go and do the discussion. Like over here, oh, okay, it's like this, so it's either this or this. So let me go and refine the definition and see whether they fit in or not. If they don't fit in, then it must be part of equity. Okay, then we can move on to the next. Part 2. This is the one that I try to discuss in line with IFRS 2 and establish that IFRS 2 is not applicable in this case. Right? Remember just now? IFRS 2, at the end of the day, we say it's not applicable because IFRS 2 has this kind of characteristics, which is not the case in the scenario. So I still remember what the case is all about is the ACCA buying an equipment and will pay in a form of shares, and the shares will be paid 1 year time. And how much they need to pay will be in a form of shares equivalent to a fixed $15 million. Okay, so this is a purchase of equipment at 15 million. So this one they tell you about the price of the equipment is fixed at 15, which is what we know from the scenario. In terms of recognition and measurement of the equipment, the 15 million will be discounted back 1 year to its present value. Okay, because you are only going to pay 1 year from now, so present value of the 15 million 1 year from now. It's like your deferred payment like that. Okay, so you have to present value the 15 million. And then this was the discussion until a little bit about here. This was the discussion on IFRS 2. This is, of course, an addition, a side kind of thing. If you can, you discuss. If you cannot, it doesn't matter, because most of the time, the students will not address this. Okay, but because it is quite obvious there, so we just want to discuss. The company is paying equipment using shares. This is from the question. All right, using ordinary shares. But you have to add value such that you want to say whether this falls within the IFRS 2 or not. So you say, however, this is outside the scope of IFRS 2. Why? Because the payment is not dependent on the value of shares, but it is fixed at 15 million. In this case, it is the numbers of shares that will vary rather than the amount. So, as I mentioned, number of shares here will be different. Numbers of shares here will change. The amount is fixed at 15 million. But in line with IFRS 2 is the balik. Number of shares is fixed. The value of the shares will fluctuate. Okay, so therefore it is not the same. Okay, so in other words, therefore this does not fall under IFRS 2, and this particular scenario, because you still owe you owe money to the supplier, because you're only going to pay them back 1 year later. So which means you have a liability, and such a liability will fulfill the definition of a financial liability. So you are going to capture this, classify it as part of the financial liabilities. And of course, initial recognition will be at the present value of the 15 million. And then subsequently, you don't measure it through the profit or loss, because this one you will find that it will fulfill the business model test and the cash flow characteristics test. So therefore, the financial liability should be measured at amortized cost. So still remember your amortization schedule. So if you measure it at amortized cost, later you will find that, oh, you need to calculate the interest, and then you are going to expense off whatever is under the column 2, and then financial liabilities will be reflected as part of the item in the SOFP. You extract from the amortization table, column number 4. Okay, got that, huh? Last one. This is the special class of ordinary shares issued to the directors. And then I hope that you have taken note, that over here we have subtitles. See, every time we start the question, we have subtitles. We have subtitles. You understand what I mean? Subtitles. Here also we have subtitles. Every time you answer the question, usually you have to put subtitles, so that you will guide the examiner accordingly. Okay, so this was the special class of ordinary shares. that dividend payments are discretionary, and then at the end of the director's service period, ACCA needs to repurchase those shares. Okay, so again, we go back to just now our analysis. It is whether it falls under financial liability or equity instrument. Okay, so first of all, in the first paragraph, they actually talk about first paragraph, first sentence. They talk about the norm, because as we know, ordinary shares are part of equity instrument. Because why? They don't fulfill the definition of the financial liability, such that there is no contractual obligation to deliver cash. Okay, so they tell you, oh, if you are talking about the what do you call that? The ordinary shares in the normal sense, they are actually equity, which we know. But you see, however, so that means these are the what do you call that? That can help you to smoothen your argument. So you say normally it's like that, but in this case it's slightly different. Why? A contractual obligation to deliver cash exists on a specific date as the shares are redeemed at the end of the service period, service contract. So normally ordinary shares no need to redeem one, no need to pay their ordinary dividends. I mean, no obligation, okay? And then you no need to redeem back those shares as well. No repayment of the principal date. Okay, so but this one different. They tell you that at the end of the contract period, ACCA needs to buy back those shares from the directors. So this particular redemption is required to repurchase. That means no choice one, cannot discuss further, no discussion. So the redemption is not discretionary. So it's not, it did not come together with the condition that says, oh, you like, you redeem, you don't like, no need to redeem, it's okay. Not like that. They just tell you at the end of the service period, you must redeem. So you have to redeem. So this is no joke. Okay. The redemption is not discretionary. ACCA has no right to avoid it. So if the obligation to deliver cash exists and you have no choice, you have to do it. So in other words, this will fulfill the definition of there exists a contractual right to deliver cash. So contractual right to deliver cash will classify this special class as part of financial liabilities. And then, of course, the next para is just to discuss how you are going to capture the financial liabilities in the books. So, of course, warning itself, we already mentioned. So, if you have financial liability, initial recognition will be at fair value. And then thereafter, you are going to measure them at amortized cost, and then you apply the effective interest rate, the coupon rate, etc., etc. Okay? And then over here, we also need to discuss a little bit about the dividend payments. So as we know, the dividend payments are discretionary. So if they are discretionary, meaning that, they tell you unless and until the dividend payment has been passed, that means ratified at the AGM, otherwise you don't have this particular obligation. So dividend payments are discretionary as they must be ratified at the AGM. Therefore, no liability is recognized for any dividends until it is ratified. When recognized, the classification of dividends should be consistent with the classification of shares. So this special class of shares is classified as financial liability. So which means if you were to pay dividends, the dividends will be captured as part of the finance cost. Finance cost will go to the SOPL. Okay, got that? Of course, the finance cost will be reflected just like your dividend payment like that. Not dividend, just like your what do you call that? Interest payment for debentures. Okay? Can I? So this one, I can also save it. Then later I can post it to the files section. So now that we have finished this illustration, we can go to the second part. So this is the second part right now. Why is this blocking? Okay, so for the part 2 of the financial instrument. So part 2 of the financial instrument, we will talk a little bit about the derivative contracts, impairment losses with respect to financial assets, and then some hedging, cash flow hedging, and then your fair value hedging. Okay, wait. All right. So this is what we have already done this morning, the portion over here. Okay, this one we have done financial assets, financial liabilities, equity instrument, recognition, derecognition, measurement, initial measurement, subsequent measurement. So it depends on whether you have financial assets, financial liabilities. All right. So all these we have already done. This one is something that you should have already covered under IFRS 13. So now we are going to look at the remaining few. Now I say embedded derivative is no more in your syllabus, but we can look a little bit on the derivatives, then impairment, then we look at hedging. Okay. So this morning we actually look at forward contracts, that we say that we can actually use the derivative to cushion the impact. Okay, forward contract or the futures contract. Forward contract. Okay, forward contract is one example of derivative contracts or derivative instrument. So what is derivative? They tell you it's a contract that allows an entity to speculate or to hedge against future changes that is going to take place in the future, but at the time of entering into the derivative contract, you wouldn't know yet, because all of us cannot read into the future. If we can fortune tell the future, then a lot of things will become, I don't know whether it's simpler or not, okay, because it's no fun already, right or not? If you know tomorrow, what is going to happen, and you are right all the time, there will be no expectations already, correct or not? Because you already know. Let's say like before the students go for the final exam for the undergraduate studies, they already know they're going to get A, and they don't want to study already. They know yeah, they're going to get A anyway, or they're going to fail. You know, those kind of things. So usually I think in life, no need to know everything so accurately, especially those that involves the future. Okay, of course now. So we say derivative is a contract that allows an entity to speculate or to hedge against future changes in the market. It is a contract to buy or sell or settle in cash. And then the holder or the writer is not required to invest or receive the notional amount of the primary instrument at the inception of the contract. So in other words, when you want to enter into this kind of derivative contracts, the initial cost outlay is very low. It's either no need money or you need the money to enter into the derivative contract, it is only very cheap, very low only. So it's like, you know, you will make use of the derivative contract to soften whatever impact in the future. Okay, it's just like, you know, when you drive and then you saw that in front of the road there are some diversion. Okay, maybe they block part of the road and then they say that, oh, this one got something ongoing. That means got this got what do you call that? Hindrance. Okay, so when you see that, of course you are going to avoid it, or you do some changes. Correct or not? You're not going to drive head on and then eventually really bang into the hindrance or a partition or a barrier. You get what I mean or not? So it's the same things. Derivative contracts is supposed to take place and it is supposed to hedge against whatever that is going to happen in the future. Okay, and then you can see the characteristics of the derivative contract. So, which means that, how do you know you are actually engaged in some derivative contract? So, you have A, B, and C. A, B, C. These are the characteristics of a derivative contract. They tell you the value changes in response to the change in the underlying variable. So which means that most of the time, the derivative contracts are tied to the fluctuations in the interest rate, in the commodity prices, or in the Bursa's index, let's say. Okay? And then this one, underlying variable is something that the entity has no control of. No initial investment is required. Or if one is required, the amount is usually very small to be settled at a future date. So usually settle net at a future date. Okay, so how do you know you have derivative contract? You must have these three characteristics in place. Examples of derivative contracts will be options, futures, forwards, interest rate swaps. So all these terminology is not something that is new to you, because when you learn your corporate finance, you know, you would have already encountered these terms. So, the next that we just want to have a quick look will be the impairment of financial assets, because later we will come back to hedging again, all right, after we look at impairment. So the earliest encounter that you have with respect to impairment is basically in line with your IAS 36. IAS 36 is impairment of assets, the standard. Impairment of assets. So impairment of assets, so impairment loss or whatever. Okay, so which means, remember what is the key thing that we are talking about in terms of IS 36? We say what? CA, if it is more than the RA, then we know that the value of the asset must have been impaired, because assets cannot be carried at above their recoverable amount. So you remember that? Okay, so which means that this is for the normal impairment of the normal assets. But right now, we are looking at impairment of financial asset. So it's slightly different. Impairment of assets, you will follow IS 36. If you have financial assets, you will follow the provisions under the IFRS 9. So it's slightly different, although before an impairment is to be so-called impairment review is taken, there must be indicators as well. So under the IS 36, we also talk about internal indicators. We talk about external indicators. Okay, so right now over here, when we have impairment of financial assets, we also say that there are going to be some indicators. No indicators, usually no need to do the impairment. All right. However, the impairment of financial assets under the IFRS 9 is the expected credit loss approach, ECL, expected credit losses approach. Okay. Later, shortly, we are going to look at how ECL operates. So what are the indicators of the impairment on the financial assets? So financial difficulty of the issuer. Of course, this is quite common, is it not? Right? So let's say if I've already issued out some bonds, and then you go and invest in those bonds. So of course, you have investment in bonds. Investment in bonds will be captured in your books as part of your financial asset. And then if you find that the issuer has encountered some financial difficulties, then the next question is, I don't know whether my value of the financial asset has been impaired or not. Correct or not? So that is when you are going to carry out impairment exercise in line with IFRS 9. Sometimes you may have indicators like breach of contract in repayments. Okay, of course, this one I think everybody also know lah. So let's say, for example, if you are paying down your loan on a regular basis to the banker, but at a certain point in time, you already missed the payment. Last month didn't pay, this month didn't pay, next month also not going to pay. So that will indicate that likely is that there is some impairment taking place already. Granting concession to the borrower not normally given. So concession means like you give a interest-free period, or they tell you that, okay, the interest rate will be revised to a cheaper rate, I grant you certain concession, certain leeway, right? So of course, this particular granting of concession, we see it during the COVID. Correct or not? Because during the COVID, of course, nobody expects that it's going to take so long, right? So some of the people who are working and getting wages on a daily basis, suddenly they're out of job. Correct or not? Because they probably do not fall under the essential services. So they have no job to do. No job, no money, but then their housing loan still needs to be paid. All right. And this and that still needs to be paid. So during the COVID time, the bankers have actually granted some concession to the loan holders, such that they say, oh, no need to pay us interest on the housing loan. They stop. The bank say, I'm not going to charge you the interest for these few months. And then there will be no interest on the overdue interest, stuff like that. So that was the moratorium that was entered into to ease the impact of COVID. Okay, so that one, of course, also is an indicator of impairment. Of course, the next one is bankruptcy of the borrower, disappearing of an active market. This one is like what we quite often see. So let's say in terms of businesses, sometimes you may find that, wow, a lot of people eat at that particular shop, let's say. But suddenly one day, you find that no one is there. All right, disappearance of the active market. This one can give you an example of a mixed rice shop in Sungai Long. So what happened is that I think because the location is quite near to Utah campus, so you find that quite a lot of students, because of the lack of time, they want fast food, so they just have the lunch at that particular restaurant that sells mixed rice. But one day, actually, I also frequent the shop. Then one day, when I go there with my colleague, I find that, wow, why so empty one today? You get what I mean? It's not the norm. So suddenly the active market has disappeared. Why? Not because of financial difficulties in this case, but because there was a video of the rats having a party with the dishes. All right, I mean, not party lah. They just saw videos uploaded that captured the mouse, the rats ran across the food. Okay, and because of that, of course, it triggers on the health ministry to come in. Then they force close the shop. So I went there after the incident, before the forced closure. So that's the reason why the active market has disappeared, which means that the value of the particular asset or the restaurant would have been impaired. Okay, so for the impairment on the financial asset is slightly different. How we do it? We don't do this. Okay, let us just continue with this. So like I mentioned, the impairment loss on the financial assets will follow the ECL approach, expected credit losses. So the expected credit losses, basically they tell you is forward looking, and then they are actually looking at credit quality. And this impairment rules applies to financial assets that are measured at amortized cost, and investments in debt instruments measured at fair value through the OCI. But if you have financial assets that are measured at fair value through the profit or loss, they tell you that it will not be subjected to impairment loss under the ECL approach. The reason is because this particular fair value would have already taken into account any impairment loss. So that means when you capture the fair value that time, the fluctuations in the fair value, any impairment loss would have already been imputed inside. So there is no necessity for you to do a separate assessment for the expected losses. This is the ECL approach. Okay, the ECL approach. Have a quick look at this ECL approach. Before that, anyone got any question or not? No? Okay. You look at this ECL approach. This ECL approach has 3 stages. You have stage 1, stage 2, stage 3. All right? So it will move from stage 1 to stage 2 to stage 3. All right? And of course, they give you like, under what kind of condition you need to provide stage 1 ECL. And when does stage 2 ECL kicks in? And then the next stage, and move on to the next stage, which is a stage number 3. So the table here says when stage 1 will be provided at the initial recognition. Initial recognition means what? Today, you have some, let's say, trade receivable. Today, you need to provide stage 1 ECL. So, in other words, today, you have certain financial assets. Today itself, you provide a stage 1 ECL. So it's a little bit funny, isn't it? How do you know that I'm not going to pay? Correct or not? But this is the method under the ECL approach. They say initial recognition. And subsequently, if no significant deterioration in credit risk. So that means if there is, in the future, there is no deterioration in the credit risk, you just stay at stage 1 now. Okay, even though you are in the subsequent measurement. However, if after you have provided the stage 1 ECL, which is at initial recognition, then subsequently, a few months later, you find that the credit risk increased significantly. So, which means that something must have happened. And then you find that, oh, now they lost one major customer, something like that. Okay, so when the credit risk increase significantly, we will say it is a rebuttable presumption. Rebuttable means what? We will assume that this is correct until and unless you prove it wrong. Understand? So, which means that up to you to prove lah. But at the moment, I'm going to tell you that this is what I'm going to take as the stand. Okay? So they're saying that, oh, if you find that, you know, the amounts to be paid is past due more than 30 days. So chances are is that you are saying that this will give you the indicator that the credit risk has increased significantly. Okay, so of course, I think this is also quite a good indicator, such that if you have no problems, why must you drag the payment till after more than 1 month to pay off? Okay, so unless proven otherwise, this will be taken as true that the credit risk has increased significantly. Then you go into the stage 2. So under what kind of circumstances you entered into the stage 3 of the ECL approach? This one, they tell you objective evidence of impairment exists at the reporting date. So this could be like a bankruptcy has been bankrupt already. So that means you get the notice that someone has been declared a bankrupt. So therefore, it's objective evidence of impairment. Okay, so now that you see, so in other words, the risk increase until stage number 3. Then the next one that we want to know is that if you are under stage 1, how to provide for the ECL? How much is the expected credit losses? So here they tell you 12 months ECL. And then when you move from stage 1 to stage 2, you're going to have lifetime ECL. Stage 3 is also lifetime ECL. Okay, so you have all these. Stage 1, 12 months ECL. Stage 2 and stage 3, lifetime ECL. What's the difference between the stage 2 and stage 3? Both also say lifetime, but it's just that the stage 2 is based on the gross carrying amount of the financial asset. Gross carrying amount of the financial asset. But stage 3 is based on the net. Stage 1 is also based on the gross carrying amount. Okay, net meaning what? So let's say you have financial asset, the carrying amount, some figure. then you are going to minus, because you're going to provide the ECL, isn't it? The ECL that you have provided, and this is the figure that exists at year end, you knock it off. You knock off already, then you're going to get the net figure. This is the net. So stage 3 is based on the net. Stage 1 and stage 2, the computation will be based on the gross. Gross meaning that before you deduct out the ECL to date. Understand? So of course, 12 months, lifetime. Gross, net. How do you know when to provide? When the credit risk increase. So initial recognition must provide. Then when you have rebuttable presumption, then you move from stage 1 to stage 2. Objective evidence of impairment, you go into stage 3. Okay? However, I just want to explain about this 12 months ECL. So how do we interpret this 12 months ECL, and what's the lifetime ECL? Okay, so just move on to here. ECL approach. So of course, we already say that ECL means is the expected credit losses. And if we are looking at the lifetime ECL, so it actually means what? Lifetime. Expected credit losses that result from all possible default events over the expected life of the financial instrument. Okay, so this will be the total. So which means that ECL, let's say like for example, this particular asset has 5 years life. So the expected credit losses in year 1, so much. Year 2, year 3, year 4, year 5. And then the probability of this particular loss occurring is 10%. 12% on for the year is 12. Okay, for the year, 12% for year 2, 12% year 3, and then it will get higher and higher lor. Probability of the expected loss being incurred. So the fact that it is expected means belum lagi become impaired. So it's likely that it will become impaired. So remember just now we say stage 1 ECL, we take a 12 months expected credit losses. And how do we calculate? We are going to take multiplying the probability of default within 12 months. Probability of default within 12 months is our 10%. By the present value of the lifetime expected credit losses that will result from the default. Assuming that this ECL has all been present value, so that means present value of the lifetime ECL is 12,000. If you want to calculate 12 months expected credit losses, what you need to do is take the percentage, you times by the present value of the total lifetime ECL. So when you take this will be 12,000, and then you times by 10%. Okay, that will give you how much ECL to be provided for stage 1 in the books. So can you just read this particular note down here? It says what? The stage 1 ECL is not calculated by taking 1,000 times by the 10%. In this case, if you take 1,000 times by the 10%, it is only 100. They say this particular way is wrong. Understand? So you can see over here, calculated by multiplying the probability of the default within the next 12 months. So this is the probability by the present value of the lifetime ECL. So you suppose you take the probability times by the present value of the lifetime ECL to get to the stage 1 ECL. Okay? So this one, you must try to understand so that you don't make a mistake on the calculation, because this one needs a 12 months ECL. Then you have a lifetime ECL. Okay? Then, of course, some people will say, wow, how to do this ECL? So, of course, in the theoretical side, I think, of course, they can say, you do this, you do this. But on the practical side, maybe it's a little bit difficult to estimate. Estimation of what is difficult? This lifetime. Okay? It will fluctuate. Probability also is not easy to estimate, but of course the theory says you have to do it like that. So the intention is that the amount recognized on initial recognition acts as a proxy for the initial expectation of credit losses. Okay, so they tell you that, actually is based on estimation. It's better we book it in the books rather than we just do it after it has occurred. So therefore, this forward-looking kind of computation in terms of ECL. And then, of course, this one tells you, after you have provided the stage 1 ECL, if the credit risk decline significantly, then they say you are going to move into stage 2, you're going to move into stage 3, and when that happens, you're going to provide a lifetime ECL. Okay? Where is this? Okay. All right. So of course, impairment means what? The particular entity must have suffered losses lah. Okay. So now we just want to see how they are presented in the books. So let's say I have some financial asset, and this particular financial asset I have already so-called provided for the allowance for ECL. So how should I treat it or present it in the books? So if you have investment in debts instrument measured at amortized cost, so ECL will be recognized in the SOPL. You have to have a separate account. You have to have a separate allowance account. So this means that you will have one line item that talks about allowance for credit losses. So the financial asset, the value, the ECL, whether it's stage 1, stage 2, whatever that you have provided, then you minus it, you're going to get the carrying amount. So this will remind you of PDD, right? Your provision for doubtful debts. So the allowance for credit losses works the same way as the provision for doubtful debts. All right? Such that, you take the difference in the opening and closing to go to the SOPL. And the total or the cumulative of the allowance for credit losses will be knocked off against the financial asset. Okay, to get to the net. This is a net. However, for investment in debts that are measured at fair value through the OCI, they tell you that, no need to have a separate line. All right, no allowance account is necessary because everything would have been captured in the fair value figure. Okay, so of course, since this is fair value through the OCI, Any fluctuations will go to the OCI. Then, of course, some of the entities will say, wow, this one very tedious. I have to do so many things in order to get this right in the books. Is there any simplified approach or not? So it's just like the accounting standards. Okay, accounting standards for those public listed company, we have the, like in the Malaysian scenario, we have the MFRS. And then for those that are smaller companies, the private entities, we have MPERS. Okay, so that one is Malaysian standards, reporting standards for those smaller companies that are not public listed. So of course, the so-called the disclosure requirements, the accounting treatments are much easier. Okay, so same things. We also ask, hey, is there any simplified approach or not? If I have so many trade receivables, all right, so how? Every time I got to go and do stage 1, stage 2, stage 3, very cumbersome. So they tell you, for trade receivables that don't have any financing component, they tell you, you just can do once only. What is the one-time kind of recognition? Just do a lifetime. No need to go and monitor whether the risk has increased or not. Just do one time. You just do stage, you just calculate the lifetime ECL. And when do you do it? From the first time you recognize it. So that will be from the initial recognition. Thereafter, no need to monitor whether, the credit risk has increased or not, whether is there any objective evidence of impairment or not. No need anymore. So it's much easier. Then this will be for the trade receivable. For other receivables, they tell you that, you can choose. You want to apply stage 1, stage 2, stage 3, that means it requires monitoring, or sekali goose go to stage 3 can already. Understand? So I think most of the companies that are having what do you call that, impairment on the financial asset, they will go on the simplified approach because not much hassle. Okay. Let me look at this. So now we want to provide for ECL. So of course, this particular provision for ECL, we try to continue from the illustration that we have done earlier this morning. That is on Palemo. Give you a few minutes to go and recall back Palemo. Let me put this side by side. Palemo. Okay, this morning we have done Palemo. This is on the part A. Okay, we have looked at this particular Palemo question. So you still remember the Palemo question? The illustration was that, initially when you buy it that time, you got a 10% discount. Then you have this intention to hold to maturity, and then you receive payment solely of principal and interest. So that is your SPPI. So therefore, we already established that this particular financial asset should be measured at amortized cost. Okay, and then we calculate, and then we have seen that, okay, that is the initial recognition, the amortization table. At the end of the day, in the SOFP, the financial assets at the end of year 1 must be reflected at 46,495. Okay, so this is the figure, 46,495. Okay, so you still recall, yeah, this one? So now let us continue from the explanation in Palemo illustration. So they tell you, oh, they already issued the loan notes, and then they have gotten into the issuer have gone into the financial trouble at the end of the first year. So Palemo learns that the company, that means this is the issuer. Company is the issuer because they have investments, issuer. They have investments in the loan notes, okay, so therefore it's part of its financial asset. So they tell you the issuer that has issued the loan notes that Palemo owns has gone into financial trouble. So the financial trouble will be the indicator of impairment. Okay, indicator of impairment. So since they have already got this indicator, which means that, oh, of course, now you have to look and see whether you need to provide any ECL or not. Okay, so when was the financial trouble existed? At the end of the first year. Okay, so if you go back to that particular illustration, you will find that this particular investment will mature in 4 years. So at the end of the first year, they already know that there are some financial trouble. And because of that, it will trigger the ECL computation. On this date, the liquidator of the company that issued the loan notes informed Palemo that no further interest will be paid. No more interest will be paid. And only 75% of the maturity value will be repaid because they already enter into financial trouble. So which means they must have gone to the what do you call that, stage 3 already of the ECL approach. And then they tell you that, since we are having this particular issue, I don't think I will be able to pay in full when the loan note matures. I'm only going to pay 75%. What was the original value of the loan note? Loan note was 50,000. Okay, loan note was 50,000. Loan note was for 50,000. Okay, so 50,000 loan notes, but I can only get back 75%. So 75% times by your 50,000. But of course, this one will be repaid when 4 years loan. The loan note will mature in 4 years, but 1 year has passed by. So which means you have remainder 3. So that is why this particular figure, you have to present value it based on the effective interest rate 3 years from now. Why 3? Because originally 4 years, 4 minus 1 year that has passed by. So 3 years will be the end. Okay, so in other words, once you computed already, you're going to get 31,845. So this means what? When the loan stock matures in another 3 years from now, you find that how much you can get back is only 31,845. You are not going to be able to get back the 50,000 in total, but less than that. Okay, so that means you have some impairment. All right. But at the end of the first year, you know that the carrying amount of the loan note, investment in the loan note is only 46,495. And then they tell you thereafter they're not going to pay you anything already. So that means your amortization table cannot keep on doing because there is no inflow, no outflow already. So basically, you know that your value is 46,495. But at the end of the day, you are only going to be able to collect 31,845. So in other words, the difference must be the impairment. So this impairment, you have to reduce the value of the financial asset and charge this to the SOPL as part of the expenses. Follow now. So this is what that is happening. Then we can look at the next illustration. Or this one, we recap one. We have looked at that already. This question number 2. This is almost the same as the polymer question that we have just discussed. Can you just quickly look at this? Give you 5 minutes to look at it. Okay, give you some time to look at this, and then you can calculate. I don't know whether I've given you the answers or not, but I think I could have. But just tally the answers. Can So you can see from this particular illustration, even though the cascade, they have purchased the debentures, that means they have investments in debentures. So investment in debentures, they are basically part of your financial asset. Okay, so investments in debentures is part of its financial asset. So they tell you that the issuer is actually Fountain Company. And when was this particular financial asset purchased? On 1st Jan 20X6. okay, on 1st January 20x6. Let me change the color because can't really see. Okay, so 1st January 20x6 for 250,000. So that means the investment value was 250,000. Then what happens? The terms of the debenture was 5 years. So that means the debenture will mature in 5 years' time. And on maturity, Cascade will get back their 311051 value. Okay, so that means they have already computed based on the effective interest rate and the amortization table. By the time 5 years is up, the maturity value is 311051. Okay, so they tell you the effective interest rate on the debenture is 10%, and the company has classified it at amortized cost. Okay, and of course, they also tell you again that this is a financial asset, which is very kind of the question. Otherwise, you have to figure it out yourself. And then they tell you at the end of 20x7, so which means they bought it on the first day of January x6. Then at the end of x7, so let's say 31st December x7. So which means how many years has passed by? From here to here, basically 2 years has passed by. Okay, x6, x7. And then you know that this one is 5 years. 5 years, 2 years has passed by. That means remaining is 3 years left. Okay, so after 2 years, the issuer went into liquidation. Oh gosh, they are facing financial issues. They went into liquidation. And then so far, for the first 2 years, all the interest has been paid up to that date. And then on the 31st December 20x7, liquidator of the issuer has informed that no further interest will be paid, and on maturity, only 80% of whatever they promise will be paid. Okay, so market interest rate on similar bonds is 8% on that day. So what happens? The question wants you to do, what is the value of the debenture that should be stated just before the impairment became apparent? So which means for the first 2 years. So you know that you can prepare the amortization table also. So this is column 1, column 2, column 3. And then this is your column 4. 1, 2, 3, 4. Okay. Initial 250. Interest based on the effective interest rate of 10%. 10% times by this, you get 25,000. The coupon rate is 6%. Where is it? Yeah, this is your 6% coupon rate. Coupon rate, you have to times by the 250. So 250 times by 6%, you are going to get how much is the cash payment. So 1 plus 2 minus 3. Then you get the 4. Then you repeat for 2 years because they tell you for the first 2 years, everything as usual, as normal. So you prepare your amortization table for 2 years. So at the end of the second year, the value, the carrying amount of your investment in debentures will be shown as 271,000. Okay, 271,000. So then the next question says, at what value should the debentures be stated on 31st December 20x7 after the impairment? Okay, so they tell you after the impairment has taken place, how much should be the value. They tell you only 80% of 311,051. Okay? 80% of this, but of course, you have to go and provide the present value factor for the next, how many years more to go? 3 years more to go, isn't it? Because 5 minus the, how much? 5 minus the 2 years. So it's 3 years more to go. So you are going to get the present value factor based on the original effective interest rate, 1 divided by 1.1, 3 years. So it will be 0.751. So you are going to get how much should be the recoverable amount for the financial asset. Okay, so once you have gotten this, of course, the impairment is the difference between the two. Okay, how will the impairment be reported for the year end? So the impairment loss will be knocked off against the financial asset. The impairment of the asset will be reflected in the SOPL. 271 knock off with 186,879. 186,879, the 271 is here. So which means at the end of the second year, the carrying amount is so much. And then thereafter, they tell you no more interest payments and stuff, but then you will get 80% of the maturity sum payable 3 years from now. So you present value it. So the difference between 271 and this two will be the impairment loss. Okay? Any questions so far? Any questions? No, Okay. So this is how you provide for the impairment loss. Okay, impairment loss with respect to the financial asset. So before we go into the next part, which is the hedging, Before I go to the next part, there is one exercise that I want you to look at. Let me just put the exercise at the file section because I think in the last round, when I put it at the meeting chat, you can't access. Let me go to the files section. And put this inside. Okay. So you can see this particular question. So this question is something like your ECL. The only difference is that this particular ECL is with respect to trade receivable. And then, of course, suppose they should operate based like stage 1, stage 2, and stuff. Okay? But then over here, how do we say? Over here, they have given you some predetermined metrics. Okay? You just have a quick look first. Then for 5 minutes or so, then I will explain. Then I will give you some time to work out this based on the, what do you call that? The guidelines here. Okay, because we need to know how to present the ECL in the books. Okay, you just have a quick look at this first while I write something on this particular question, yeah? Okay, so if you look at this particular illustration, ambush, they tell you on the first day of December 20x4, ambush sold goods on credit to trade. So that means trade must be the trade receivable. Okay, they sold goods on credit. How much is the value? 600,000 worth of goods. And then they tell you, trade has a credit limit of with ambush of 60 days. So credit limit of 60 days means what? Today you buy, then you must pay within the next 60 days. Otherwise, it will be considered as overdue. Okay, so ambush applies IFRS 9 financial instrument, but then they use the predetermined metrics for the calculation of allowances for receivables. So they tell you, suppose we know we need to do stage 1, stage 2, stage 3, but this one we have tested it, and then we would like to adopt the predetermined metrics kind of calculation for the ECL. Okay, so they tell you, you see this particular predetermined matrix is like this. If the so-called trade receivables is not overdue, that means 0. Overdue days is 0, which is the same as our stage 1 ECL. Remember, stage 1 ECL is supposed to be the ECL that you are going to provide at the initial recognition. Okay, you remember? Still remember? At the initial recognition. No, this one. I closed the file, yeah. Here. At the initial recognition. That is your stage 1 ECL. Stage 1 at initial recognition. So even though today only you buy the products on credit, today itself, even though there is the trade receivables being created today itself, you must provide some ECL. That is considered as a stage 1 ECL. So they tell you, even though there is no overdue days, we still have to provide 1%, which is the expected credit losses ECL amount, stage 1. However, if you move to the next matrix, that means the next stage, whereby the numbers of days overdue is from 1 to 30 days, then you move from the next stage to maybe this one we can call as next stage, stage 2, or the subsequent stage. Okay, so you understand what I mean? So you see, for this particular case, they bought the goods, ambush sold the goods to trade on the first day of December. So until the end of December, because they bought it on the first day, so until 31st December, it will be 30 days outstanding. Okay, not yet pay ma. Then after December X4 already, the next will be what day? January of 20x5. So they tell you by 31st January x5, trade has not paid and therefore fail to comply with the credit term. Because if they pay on the 30th of January, still okay ma. So you still are on the first row of the matrix. But then on 31st January 20x5, they still not yet pay. So which means 30 plus 31 is 61. And then they tell you that the credit term is only 60 days. So you compare these two, you are 1 day overdue. Overdue by 1 day. So if it's a 1 day, that means it comes under this. 1 day, that means you move to the next level of the ECL. Okay, and ambush learned that Trey was having serious cash flow difficulties due to a loss of key customer. So this is to reiterate that actually the credit risk in the trade receivable Trey has increased significantly. Okay. Financial controller of Trey has informed Ambush that they will receive the payment. Of course lah. Ambush financial controller say, hey, don't worry lah. This one loss of major customer, not a big issue. We will solve it. I'm sure you're going to get your money. Okay. But all these reassurances are not useful to us, right? So what we need is payment. If you don't pay on time, then we have to go and provide the next stage in accordance to the metrics or in accordance to the stages of ECL. Okay, so they tell you, show the accounting entries on 1st December 20X4. 1st December 20X4 is the date that the goods were sold to the customers on credit. Okay, and that's the day when the trade receivables is being created. And then they say another date will be on 31st January X5. So this is 31st January X5, the date that they tell you money has not been paid. Okay, and in accordance with the expected credit losses model under IFRS 9. Okay, so I have provided the template of answers for you. All right. And since this is 6 marks, so always remember every mark you only have 1.8 minutes to do. So 6 times 1.8, you're going to have 10.8 minutes. So maybe we just give you 11 minutes to try. Okay, so accounting principles, accounting applications. So remember, always the approach is like this. But a cursory look at your progress test scripts, I find that a lot of you do not follow the principles. You just have go direct to the application. So if you go direct to the application, you will find that you lose marks on the accounting principles. They always will split. Some marks goes to the accounting principles, some marks goes to the accounting applications. So if you didn't provide this, let's say you didn't provide this, that means the marks allocated here, you're not going to collect. Okay, so try to fill in the blanks over here as what I have explained, and then we will look at it. Okay, Ken, I give you 11 minutes. So minutes 11. So we will look at it at 3 o'clock. Okay, so give you some time to look at it. So no need ready. $11 minutes for you to do, correct or not? 6, 5, 11. Okay, so 3 o'clock. No, not 3, sorry. Maybe I give you a little bit more time until 3:10, huh? Okay, so you attempt it. And if you finish already, you just crop it at the meeting chat, and then you can go for a short break. So anyone has completed at least a certain portion of it? Hello? No? Okay, never mind. So we will just run through lor. Oh, anyone completed? Oh, okay, that's great. Let us see. Maybe we cut portion by portion, huh? Too small. $600,000 TR sales, profit or loss. Let me just have a look. Huh? How do I cut it to become bigger? I enlarge. Next one. Okay, so we can see this. Save as just as my desktop. Ambush. Maybe I just PDF it. Stop. This one we no need. Okay, let us just look at this. Okay, so what do we have over here? So we actually say that, okay, under the answer guides, of course, you have to go and put down the principles, then only followed by the accounting application. So maybe we can just enlarge this portion and look at the principles first. So we actually say that, for trade receivables that do not have IFRS 15 financing components, this one we have already seen earlier. If we know that there is no financing components, loss allowance can be measured based on the lifetime expected credit losses from initial recognition. So, which means that we know that, if you don't want to go and do stage 1, stage 2, and all those, you can actually do a lifetime expected credit losses. Okay, so when you have a simplified approach, this will be permitted in line with IFRS 9. All right. And then the accounting applications. So which means that right now, you are going to take the facts from the given, take the facts from the given case to put inside the accounting applications. So we say that, you know, there were some transactions entered into to sell goods to trade. So which means that you create some trade receivables. And the amounts will be 600,000. And of course, this should be reflected in ambush books. So in this scenario, there exists a predetermined matrix. So you have to use the predetermined matrix for the calculation of the allowances under the allowance for expected credit losses. Okay. So now we can just look at this. So what happens? We are supposed to just provide the entries in the books for ambush. So on the first day of December 20 X4. So that's the date when the so-called the trade receivables was created. So this is a simple journal entry that do not require any knowledge of financial instrument, correct or not? Because this is just some credit transaction with respect to the trade receivables. That's all. Okay. Let me just this one because I can't see the bars so I will close this, close, and then run it using Microsoft Edge. Okay. All right, so this is what that is happening. So for the trade receivables, of course, on the inception, on the day whereby the goods were sold to the trade receivables, you create a trade receivables law. The trade receivable is called trade. So 600,000 will be the amount. So of course, at the same time, you have to recognize the sales revenue. You credit the sales revenue of 600,000. Okay, then come the first level of the predetermined matrix, because they tell you that at the initial recognition, you're supposed to have provided 1%, okay, 1% as the expected credit losses. So it will be what? 1% of the 600,000. So you're going to put there debit, profit, or loss also can, but more specifically, maybe you can put expected credit losses, profit or loss, 6,000. How do you get this particular 6,000? This one, you can put the expected credit losses, and then that goes to the profit or loss. Okay, so you will have the 600,000, okay, expected credit losses that goes to the profit or loss, 6,000. So this is the so-called the first level of the matrix that was recognized as ECL on the first day of December 20X4. Okay, then what happens? On 31st December 20X5, this was the date whereby we say that the payments has not been received from the trade receivable. So on this date, you're supposed to apply the predetermined matrix for the calculation of allowance for receivables. Trade has moved to what? They have moved to the second level of the matrix, which is the 5% bracket. Okay, second bracket, which is 5% bracket. okay, because it has exhausted the 60 days credit limit. Because remember, we say that, oh, from this date to this date, actually is 61 days outstanding. But the credit limit was 60 days. So that means it's out by 1 day, overdue by 1 day. Okay, so because it is overdue by 1 day, so you find that you have gone to the next stage, okay, which is the 5% bracket. So despite the assurances that Ambush will receive payment, so of course we already mentioned that, you know, whether or not there were assurances given by Trey, then it doesn't actually affect our accounting treatment. So assurance or no assurance, it doesn't matter. Okay, so we just need the money only, right? We just need the payment. We don't need assurances after assurances. So because of that, they tell you, even though the CEO or of Trade actually just says that, oh, we are going to pay you, Ambush will still increase the expected credit losses allowance to reflect the increased risk. Okay, so they have to because they have no choice. Then the entry in the books at the end of the 31st January 20X5 will be as follows. Okay, so this one, you can actually reflect 24,000 because you can actually open this particular T account. Let's say allowance for credit losses. Originally, on the day of the recognition of the trade receivables, you have already recognized 6,000. 6,000 allowance for credit losses that has gone to the profit or loss. Okay, so this is on the first day of December X4. Okay, so there was 6,000 being so-called provided for. And then the question also tells you that, you know, the second level, 5%, you need to provide 5% as ECL when you move to the next bracket. So it will be 5% of the 600,000. 5 times 6 is 30, right? So which means you're now into the 30,000 as the balance brought forward. Balance carried down. Okay. This figure will be carried to the following year. Balance carried down. Okay, so you're going to have this already. So in other words, this particular allowance for credit losses operates the same way like your provision for doubtful debts. So which means for you to balance off this particular account, you are going to show the difference to the SOPL. So this is also to the profit or loss, and this will be 24,000. Okay, so in other words, here it is correct. So you can actually put 24,000 debits and credits. So the only thing here is that if you are going to maintain an allowance for credit losses, so you shouldn't directly offset against the financial asset. It's just like when you provide the provision for doubtful debts or when you provide depreciation, so you're going to accumulate it in an account. So here, maybe you can put allowance for credit losses so that you can accumulate the figures. So first time, 6,000. Second time, allowance for credit losses. For credit losses, you can put in the 24 so that later everything will be accumulated inside the accumulated an allowance for credit losses, so that you know the figures to bring to the SOFP will be at 30,000. So that is how you got this figure, and the trade receivables will be from the first entry here. Right? Trade receivables 600,000. So net carrying amount after the allowance for credit losses will be at 570. Okay, so this is good. Let me just go back to here. Right. Thank you, Dongmun, for sharing the answers. So this one later we will upload. So this is ambush. ECL. ECL trade receivables, trade receivables. Okay, so you got an idea how to do this already, yeah? Okay, so now we can move on to the next part of the notes. Okay. Let me move to the next part, which is on the hedging and the derivatives, hedging, hedge accounting. All right, just give me a minute. It's getting dark here because it's going to rain. Let me on the lights. Okay, so we are going to move into hedge accounting. So remember, for this one, we are supposed that we will look at hedging. Impairment we have already done. Derivatives, we look at it a little bit already. So now we are going to move on into hedging. Okay, so for hedging, we will look at how is it that whether hedging is useful or not to us. Okay, and why is it that, you know, most businesses will engage in some kind of hedge accounting. Okay, so we just move back. Okay, so for this particular hedge accounting, basically is to reduce business risk. Okay, you need to reduce business risk. Of course, all businesses have risk lah. So you need to reduce the business risk. How are we going to reduce it? That means we are going to do something if we suspect that there may be some activities or some events that happens in the future that will increase those business risk. Okay, so hedging transactions are entered into in order to reduce the business risk. So especially if the item in the SOFP or future cash flow is subject to potential fluctuations in value that could be detrimental to the business. So let's say, for example, if you are in the aviation industry, so which means that, you know, you have a lot of aeroplanes, you know, especially susceptible to the fluctuations in the price of the crude oil. So that means jet fuel, let's say. So the fuel, because if let's say there were some events that happen in the world, maybe war or threatening of war and the nuclear war, etc. So it may actually spike up the price of the fuel. Okay, or maybe you find that there could be some events that could be unfavorable to you, and if that particular event takes place, then it may actually erode your profits. So at that point in time, probably it's good for you to engage in some hedge accounting, so that you know that you will be impacted by the adverse events. But if you have engaged in some hedging process, it is expected that your impact is not so painful lah, put it that way lah. So it's just like we say, if you know that you're going to fall, of course you would like to fall on a floor that is well cushioned rather than on the hard brick floor. Okay, so it's more painful, right? But you know that you cannot stop from falling, so you can just make the conditions more favorable to you. So that is what hedging is all about. So they will tell you that, you do something better than do nothing. But hedging does not mean that it is always favorable to you. So it's also some risk. All right. It doesn't mean that it's always favorable, but depending on the scenario, usually hedging will be engaged when they find that the chances of being favorable is higher than if you do nothing. Okay, so for hedging to take place, usually we will say that you have two items that is of concern. Number one is what we call the hedge item. Number two is the hedging instrument. Okay, so these two items, like we say here, the aim is that where the hedge item, let's say we take the coffee beans, is making a loss. So that means you make losses. So negative, this is a loss. And the hedging instrument, example, the futures contract, will make a gain. So it will come with a positive. So this is a gain. So suppose the gain and loss will offset each other. But of course, we cannot offset until ngam-ngam lah. All right. Usually, we know that it will offset to a certain extent, but we cannot offset the gains or losses exactly until they become zero. Okay. But we will have some savings, net-net, or some losses, net-net. But hedging does not mean that it is always profitable one, not always ended up in a favorable situation. So, for example, over here, if you have the hedge item, which is coffee beans or the jet fuel, all right, and then your hedging instrument could either be futures contracts or the forward contracts. If one either the hedge item of the hedging instrument. Let's say the hedge item is suffering a loss, the hedging instrument will have a gain. So these two, one gain, one loss, are supposed to offset. But like I say, the offsetting does not mean that you offset until ngam-ngam become kosong. Okay, but it can cushion the impact. That is what it means. And usually, the hedge item and the hedging instrument will go in the opposite direction. So they must go into the opposite direction. If they don't go in the opposite direction, then there is no way that they can be offsetted. Okay, so they must move in the opposite direction. One of the examples that I can cite with respect to this hedging, hedging that is in place will be like, let's say, for example, you talk about Milo, okay? Milo. Of course, Milo, the ingredient, raw materials should be the cocoa beans, sugar, chocolate, and I don't know what else lah, okay? But let's say the price of the cocoa beans is subjected to the market volatility. So of course, all these are commodities. So the commodities got ups and downs. And because the cocoa beans, they are actually a commodity that is traded on exchange. So you will find that the price will fluctuate. However, when this particular raw materials is made into Milo, the drink, okay, you wouldn't see the Milo drink that the shops charges you fluctuates that frequently. Understand what I mean? Of course, over the years, the price of the drink must have gone up. But you wouldn't see like Monday, they charge you 2 ringgit for a cup of Milo. Then Tuesday, it become $2.50 just because the price of the cocoa beans have gone up. All right. Then Wednesday, they charge you at $2.80. Then suddenly on Friday, they become $2.10. You know, you wouldn't see the fluctuation so drastically, but maybe $2.10 today. 1 year later, maybe $2.40, and along the way, they probably increase 10 cent, 10 cent, 10 cent like that. So why? Why is it that the price of the Milo drinks do not fluctuate a lot? Although we know that the commodity that is actively traded, the price of the cocoa that is actually traded in the market is based on the market volatility. And of course, cocoa beans is one of the agricultural produce, and then you will find that it actually depends on the harvest. So maybe the harvest is good, so the price of the cocoa beans will drop. If the harvest is bad, then the price of the cocoa beans will go up. All right. So it fluctuates a lot. So the reason why the price of the Milo drink does not fluctuate a lot is because of the use of derivative that is extensively used to manage the risk. And that will affect the price of the Milo. So we also know, over the years, of course, we think that the price of every product will go up, but then it doesn't fluctuate that much, although the commodity prices fluctuates a lot. Okay, so that means something must be doing the balancing for you. All right, and that is the derivatives that is used extensively to manage these fluctuations. And then, of course, derivatives, sometimes not only derivatives, sometimes you will find that a lot of people will engage in derivative contracts as part of the hedging because of the low cost of entry. But then you have to be very careful because those things that are easy or low cost of entry and may have high potential return are often used for speculative purposes. Okay. And then, of course, there are also people that says that, derivatives, although they are supposed to be good, they are also weapons of mass destruction. Okay. So if used wrongly, they could actually wipe out all your profits. So it have to be used with caution. Okay, so we can illustrate from here. So we use the hedging instrument together with the hedging item. Hedge item is the coffee beans. Hedging instrument is the futures or the forward contract. All right, so over here, pumpkin acquired inventories of coffee beans. So this is the hedge item. Hedge item. Then the futures contract is the hedge instrument. Okay, so you have hedging item, the hedging instrument. So they acquired the inventories of the coffee beans on 30th November 20x6 for their fair value of 1.3 million. So, which means that they acquire because they know that they need the coffee beans. So they buy. So in their inventories now, they have coffee beans that is worth 1.3 million. And then Pumpkin is worried that the fair value will fall, so has entered into futures contract to sell the coffee for its current fair value in 3 months' time. So, which means what? They enter into some futures contract. So, what they have done is they have bought the coffee beans and then they put in their warehouse. And the coffee beans is worth 1.3 million. But suddenly, after they have already completed this particular transaction, suddenly they hear that weather condition in those plantations that produce the coffee beans is going to have a bumper harvest. Bumper harvest means very good weather. The harvest will be high and good quality, let's say. All right. So, which means what? Then whatever that they have in the warehouse may be facing a decline in the value, because when the harvest is good, the selling price will be lower, right now, because of the quantity of supply is higher. So what they did was that, I better do something about it because it's going to get cheaper and cheaper. So what have they done? They enter into the futures contract now to sell the coffee that they have in 3 months' time at the same price of 1.3 million. Okay? So of course, sometimes there is this information asymmetric. So that means even though there is information out there, the people or the businesses, they get it at different times. Understand? So there is this mismatch of the information. So maybe some people didn't hear of the good bumper harvest. So they say, oh, very cheap, very cheap. I will buy off this particular futures contract. Then at the end, which is 31st December 20x6, you find that the fair value of the coffee beans really has dropped. It has dropped to 1.2 million. Okay, so that means when you buy that time, whatever in your warehouse is 1.3. But luckily you enter into a futures contract to sell at 1.3. But 3 months, no, not 3 months, but on 31st December, which is 1 month later only, then you find that, wow, the value of the coffee has actually declined by 0.1 million. So if you are going to assess the status at 31st December 20x6, you can see from here. Let's say no hedging with no hedging. Okay, we see no hedging. So if you do nothing, all right, you do nothing. Of course, you're going to suffer a loss, correct or not? Assuming the net realizable value is equal to the fair value, a loss of 0.1 million, you need to recognize it at year end. This is your year end. Okay, because the fair value, which is taken to be equivalent to the market value or the net realizable value, has gone down. And remember, inventories are supposed to be measured at the lower of cost or the net realizable value. So of course, when you compare these two, you know that you have to take into account 0.1 million as the loss. So of course, this is what we call the hedging H item. H item. H item versus your hedging instrument. Okay, HI lah. So you find that over here, of course you do nothing, just buta, you lose 0.1 million because you kept stock. Okay, so of course, if no hedging is involved, this one will be not applicable. So we will now look at with hedging. What happens if you do have some hedging in place? So of course, you hedge, that means you enter into some futures contract, but this one is something that cannot be helped. Okay, the price or the fair value of the coffee beans has indeed declined to 1.2. So which means you will still suffer a loss of 1.2 million. All right, whether you hedge, you don't hedge, is actually the reality. The price of the coffee beans has declined and you have suffered a 0.1 million loss. Okay, and of course this loss, same like with no hedging, it will go to the SOPL. However, if you have entered into some futures contract, so the futures contract says that what? 3 months down the road, you're going to sell for 1.3 million for the current fair value. So you're going to sell for 1.3 million. Okay, at the same price. But you know now that the fair value of the coffee beans is only 1.2 million. So in other words, this one, you are going to make a gain of 0.1 million. Okay, you understand what I mean or not? So now there is a buyer that is willing to pay 1.3, but actually the value is only 1.2. All right, so the gain on the futures contract is 0.1 million as the contract allows the holder to sell at 0.1 million more than the market value. So there will be a gain here. This one is a loss. So supposedly under conditions that are theoretically theoretically feasible, you will find that the loss of 0.1 will be compensated by the gain of 0.1. So therefore, the impact will be offsetted. But if you do nothing, you will surely have a loss of 0.1 million. But sometimes in the practical kind of condition, the offset cannot be betul-betul offset until becomes zero lah. Understand? Okay, so we move on now. So of course, for hedge accounting to be applicable, they will tell you that there are certain conditions or the criteria that must exist. So the first one, you must have a hedging instrument, you must have hedging items. Okay, these two you must have. Oops. You must have hedge item, you must have some hedging instrument. And what happens is that this particular type of hedge accounting must be designated at inception. Okay, so that means if you want to take it as part of the hedge accounting, you must indicate it at the inception of the so-called contract. And then hedging relationship must meet all the hedge effectiveness requirement. So this one will tell you, between the hedge item and the hedging instrument, there must be some kind of relationship. And they must move in the opposite direction. One gain, the other will make loss. All right. And then the effect of the credit risk does not dominate the value changes. So remember, credit risk is not only the reason why the relationship is moving in the opposite direction. There must be having other factors as well, not only because of credit risk. And then they tell you the hedging ratio must be the same. So in other words, the hedge item and the hedging instrument must have the same quantity of the items that you are actually hedging. Otherwise, it doesn't work. Okay? And then over here, you can see that there are two types of hedges. Okay, two types of hedges. The first one is a fair value hedge. The second one is a cash flow hedging. All right, so fair value hedge, you have the illustration, joules in your cost book at page 168. This one, I guess you can go and look at it by yourself because this fair value hedge is quite simple. So what I will do is I will run through cash flow hedges because cash flow hedges, as captured in the cost book is for 1A. And then cash flow hedges has what we call recycling. Recycling. Have you heard about this particular recycling? Recycling means that initially, let's say when you enter into this kind of hedge accounting, you find that there are certain gains, but the gains has not been realized yet. Okay, so which means that you have unrealized gains initially. Because why do we say it's unrealized? Because it has not yet been collected in cash. Okay, so which means that unrealized gain, later you will capture them at the OCI. Because remember, all the realized profits, excuse me, all the realized profits are usually captured in the retained earnings. Okay, unrealized, you go under OCI. And then when this particular gains, it becomes realized, you are supposed to transfer the OCI component to the retained earnings or to the profit or loss. So you will see that initially you capture in the OCI. After it has become realized gain already, you're going to remove it from the OCI and transfer it to the retained earnings or to the profit or loss. Understand? So which means that the same gain, you are going to recycle from the unrealized to become the realized profits or the realized gains. So we will use this cash flow hedges using the illustration of 1A to look at how the recycling is taking place. Okay? So we move on. And of course, over here, just a little bit with regards to the comparison between the two fair value hedges and the cash flow hedges. So you will find that for fair value hedges, all gains and losses on both the hedge item and the hedging instrument, you will put them directly in the SOPL. Okay, just like just now, the what do you call that? The cocoa beans, is fair value hedges. If the hedge item is an investment in an equity instrument held at fair value through the OCI. So of course, the gains and losses will be recognized in the OCI component. Okay, then we will look at cash flow hedges. So they tell you cash flow hedges, when you have gains or losses on the effective portion, is recognized in the OCI first, and then later reclassified to profit or loss. This is your reclassification, is your recycling. Recycling of the profits, remove it from the OCI and keep it in the profit or loss. Okay, any excess is recognized immediately in the profit or loss. All right, so thereafter, when it becomes realized already, so you recycle from the OCI to the profit or loss. Okay, or of course, profit or loss later will be captured in the retained earnings, so it is recycled back. So now we can look at the 1A, illustration of 1A. 1A is a successful international airline. So of course, this is the aviation industry. Okay, so of course, now when you want to fly, it becomes very expensive already. Okay, so now the holiday trips, because after 2 years of not able to go anywhere, a lot of people are now engaged in international travel, where especially to China. because China now has a free visa period, right? So everybody is rushing to go to China, and then it is not cheap anymore. Long time ago, it was very cheap. Now it becomes more and more expensive to travel. Air ticket has gone up. The tour packages also has gone up. Okay, so we look at this. One Air is a successful international airline. Key factor affecting One Air's cash flow and profits is the price of the fuel. Okay, because this is the major part of the operating expenses in the aviation industry. So if the price of the fuel go up because somewhere they're threatening to have war, habis lah, all the profits will be gone. So because the price of the fuel is always fluctuating, all right, then of course it will be very normal for One Air to engage in hedge accounting. So they enter into a forward contract. To do what? To hedge its expected fuel requirement for the next quarter of 20X9 for delivery of 28 million gallons of jet fuel on 31st March 20X2. Okay, so which means what? They are now going to do some enter into a forward contract on this date, 1st October 20X1. So this particular forward contract will mature on 31st March X2. So October, November, December, January, February, March is only a 6 months time frame. 6 months. And when they enter into this particular forward contract, they actually enter it for 28 million gallons of fuel. And at that time, the price of the fuel is 2.04. Okay, so how much did they have to pay? I mean, what's the worth of this particular forward contract? 28 times by 2.04. So it is 57.12. Okay, million. 57.12 million. All right, so this is what happens. And then they tell you the airline, when they enter into the forward contract, they intend to settle the contract net in cash. So, which means that this is a characteristics of the derivative instrument. So, what's the characteristics of the derivative instrument again? We just go back to the characteristics of the derivative instrument. So, earlier we did mention for derivative instruments, they must have all the three characteristics. The first one, the value changes in response to a change in some underlying variable. So, of course, here the price of the crude oil changes, and then the jet fuel will change accordingly. But of course, this is beyond the control of anyone. This is because of the business environment. No initial investment, and it is supposed to be settled net in the future date. Okay, so this is the characteristics. Which page am I? Okay, so this will be settled net in cash. But since we know that this is a forward contract, we already know that this will have very low or zero initial cost. Okay, and we know that fuel is something that is a commodity, and then it will be subjected to fluctuations in certain development. So it is something that is beyond our control. So which means that the forward contract is actually a derivative instrument. Derivative instrument. Okay, so forward contract is your derivative instrument. This is also your hedging instrument. The hedge item is your fuel. Okay, because remember, for the hedging to take place, you must have hedge item. The item is your fuel. This is your hedge item. Hedge item is your fuel. Okay. Hedge item is your fuel. All right. Hedging instrument is your forward contract. Okay. So you have this, okay. Why, all the thing have gone. Let's see, when you enter into the contract, it was on the first day of October 20 X1. How much you have to pay? 28 million gallons at 2.04. So the worth of the forward contract is 2.04 times by 28. 28, 57.12 million. Okay. Then what happened? They tell you they're going to settle net in cash, and because this is a forward contract, you will find that initial entry cost is low, and then settle net in cash subjected to fluctuations based on some underlying variable. So of course, we know that this is a derivative contract. Okay, and then they tell you later when they have already expired this particular forward contract, they will purchase whatever fuel quantity that they require in the open market on 31st March 20X2. So in other words, what they're saying, today we are going to hedge for 28 million gallons. All right, but later we are going to settle this transaction net in cash. So meaning that if we make a gain, money will flow into one airlock. But if the decision is wrong, they got a loss transaction, then they have to pay up lah, dig out their money to pay for the losses. And whatever it is, whether they make gains or losses, whatever fuel requirement that they are going to require for the actual aeroplane to fly, they are going to buy it then. Okay? So which means that the derivative contract is just nice for this purpose because you will not have to take possession of the fuel. Because if you have 28 million gallons of fuel, how are you going to store? There is no way you can store because this is a very combustible kind of material. All right. So this is the scenario now. And then what happens? 3 months later, because remember, this particular forward contract is for 6 months. 3 months later, what happens? 3 months later, the forward price for the delivery on 31st March 20X2 has gone up to $2.60 per gallon. Okay, so when do you enter into the transaction? October, November, December. So which means on 31st December 20X1, now the 28 million gallons of jet fuel that you have entered into in the forward contract is now worth how much? $2.16. 0.16. So that means, are you making money or not? Yes, because the price of the fuel has gone up. Okay, so 28 million times by 2.16, that will be 60.48 million. So you compare these two, because your forward contract now is worth much more than what you have paid when you enter into it. So 57.12 minus 60.48. So you're going to have 3.36 million. That's the difference between these two figures. However, even though this is a gain, but this gain is what we call unrealized, because you haven't actually collected them in money yet. Not yet. Okay? Not yet. Then what happens? 3 months later, the price has gone up, so we know. Then they tell you, all necessary documentation was set up at the inception of the contract, and this is supposed to be accounted for as a hedge. So that means hedge accounting is applicable in this scenario. And then they tell you, you should assume that the hedge was fully effective. And then on 31st March, company settled the forward contract net in cash. What is 31st March? On the expiry of the forward contract, or on the maturity of the forward contract. And then they purchase whatever jet fuel requirement at the spot rate of 2.19. So that means on 31st March, the price of the jet fuel has gone up to 2.19. Okay, and based on the fuel requirement, One Air has just purchased the 30 million gallon on the 31st March based on the spot price. Spot price means what? The price as at that day. What that day is? 31st March. X2. Okay, so of course the question says discuss with suitable computations how the above transaction will be accounted for in the financial statements for the year ended 31st December 20X1. So this is at year end. And on the date of settlement. Date of settlement will be 31st March 2. Okay, so of course, this particular fluctuations in all the price of the jet fuel must be taken into account, right? And on the year end, supposedly you need to do a remeasurement of the value of the forward contracts. So this is the answer lah, but before I run through the answers, I want you to run through the scenario so that later when I run through the answers that time, it will be easier for you. You just take about 10 minutes to run through first what I have discussed so far. Okay, I'll give you 10 minutes to run through. Okay, you have gone through the question already. And then it's very heavy rain. I hope you can still hear me. Okay, so as we are saying, the forward contract is used as a derivative contract, and we are actually applying the hedging accounting. Okay, the use of the hedging accounting is to what? Is to reduce the business risk. All right. So as we know, just now we have seen the one air illustration, at least the question part. We know that there is this fuel for the aviation industry, that means for the aeroplanes. This will constitute a big component of the cost. So if they know that the price of the fuel is going to go up consistently, maybe some countries has already declared war or whatsoever, then of course the supply of the fuel will be more restricted, and therefore the price of the jet fuel will go up. Okay, so let's say there were some rumors and etc. And even for the jet fuel, for the aviation industry, even then, you know that the jet fuel is always susceptible to the ups and downs. And then to reduce the fluctuation, the impact of the adverse fluctuation in the price of the fuel, they tell you that, oh, we are going to enter into some hedging, some derivative instrument that will be used in our hedge accounting. But of course, jet fuel is not all the while up, up, and up. There is one time whereby I think the Middle East, they are selling because maybe a certain retaliation. All right, they're selling at super cheap. And at one point in time, I don't know whether it's true or not, someone was telling me that, because you can't store, so what they do is that they are selling to you cheap, and they are selling to you and paying you to buy from them. I don't know how true lah. Okay, but of course there are many types of scenarios. So in this particular scenario, we will see that when one air entered into the forward contract, it was at $2 and 2.04 per gallon. So the price was low when you compare to 3 months later at the year end. This is year end, where the price of the fuel has gone up to 2.16. So when you compare these two, you will find that the forward contract value has made a gain of 3.36. So like I say, because you haven't actually finished, only 3 months is up for the 6 months kind of forward contract. So you don't know what is going to happen in the next 3 months. So for now, at the year end, which is 31st December 20X1, you find that there is this unrealized gain of 3.36 million. Then you still have 3 months more to go on this particular contract, which is going to mature on 31st March 20X2. So it has gone up again to 2.19. So which means we can actually, no space to write. So which means on 31st March 20X2, the price is now what? 28 million gallons, but the price has gone up to 2.19. Wow, lagi go up. If you go and see the price of the fuel per gallon, 2.04, 2.16, 2.19. So 28 million times 2.19, that will give you 61.32. So if you take this figure 61.32 at the year end when it matures versus this figure, because now in the books, the figure will be this. So the difference between this and this will be what? 60.48, 0.84 million, and this is also a gain. But you realize that 31st March 20x2 is the maturity date of your hedging instrument. So which means that 0.84 will be a realized gain. Okay, so now we can go and look at how do we account for this transaction in the books. So this is the start of the suggested solution. They tell you, given that One Air is hedging the volatility of future cash flows to purchase the fuel. So they have used the forward contract as the hedging instrument, and therefore this is to be accounted for as a cash flow hedge. Okay, because this is not talking about the fair value of the jet fuel, but rather the cash flows that they require to buy the jet fuel. Okay, so of course they tell you that, oh, assuming all the criteria for the hedge accounting is met, so therefore you are going to account for this as hedge accounting. So if this is hedge accounting, and if you are using forward contract is part of the derivative contract. Derivative. So remember, we say derivative contracts has very low or zero initial cost. So if you have low initial cost, at least you can record something. If there is no initial cost, there is nothing for you to record. However, you must let the users of the financial statements know that One Air is already a party to this particular contractual arrangement. So you need to reflect it in the books. But then they tell you at inception, no entries is required because there is no outflow. But then you need to disclose the fact that a forward contract has been entered into in line with IFRS 7. Okay, so what happens? On 31st December, 31st December is the year end. Year end. Because you enter into the contract on 1st October, right? 1st October, X1. So which means October, November, December, 3 months down the road. 3 months after you have entered into the forward contract. So they tell you, oh, we are now supposed to go and value how much is the worth of this particular forward contract. So remember just now, we are actually, the quantity, as mentioned in the forward contract, is 28 million gallons of fuel. At that time, when you enter into it, which was on the first day of October, you pay 2.04. Then 3 months later, which is on 31st December 20x1, the price of the fuel is 2.16 already. So it went up. So which means now the forward contract will have this value of 60.48. Whereas when you first entered into the forward contract, the value of the forward contract is only 57.12. So which means you have a gain. But this gain, like I say, is unrealized. If it's unrealized, you cannot put it in the SOPL, but rather you are going to recognize it in the OCI. Why? Because they tell you the money you haven't collected yet, so it's only like on paper only. So what will happen is that since the value of the forward contract has gone up, you have to debit the forward contract. And since this is an unrealized profit of 3.36, we have to reflect it in the OCI. And then later you will see that this particular OCI needs to be recycled when they become realized. Okay, so we look at 3 months later. Just now 3 months is year end. From the year end to the date the particular contract matures. So another 3 months. This is what One Air will do. Okay, but we will come back to this. So on 31st March 20X2, this is where the forward contract will mature. That means it will end there. So they are going to settle the forward contract, settle net in cash. Okay, so which means what? At that point in time, when you enter into it, this was on first day of October. You pay 2.04 for 28 million gallons of fuel. So the value was 57.12. But the forward contract that is maturing today, and today's rate is at 2.19. So which means 28 million times by the spot rate of 2.19, you're going to get 61.32. So which means cumulatively, there is a gain of 4.2. So in other words, for this particular derivative contract, you are not going to take possession of the 28 million gallons of fuel, but you just settle net. So since this is a gain situation, what is going to happen is there will be inflow of 4.2 million for One Air as the gain on this particular contract. Okay, and then what happens? On 31st March 20X2, One Air will require some fuel. But since this one is a derivative contract, so they don't take possession of the fuel. They have to buy whatever fuel they require from the open market based on the rate and that day. So the rate of the fuel on that day is called the spot rate. So it is at 2.19. So how much they will have to spend to buy the 30 million of the fuel? So they're going to spend 65.7. Okay, so in other words, your next question will be, what's the use of entering into the forward contract and then later you're going to buy whatever fuel that you require from the open market? Of course, whatever that you made in terms of the gains, all right, the gains, you are going to compare with what would have been if you didn't enter into a forward contract. So we are going to look at it shortly. Okay, so what happens? Remember over here, the total gains is 4.2. And earlier, we have done this particular analysis. Earlier, we know that at year end, unrealized is 3.36. And then we have passed a journal entry for this. Remember, we have passed a journal entry for this, 3.36. So 3.36 has gone to the OCI. And then the remainder, which is 0.84, 0.84, it is actually a realized gain. This one previously recorded in the books is unrealized. Okay, so what is going to happen? Now we need to pass the journal entry. Because you're going to settle net in cash, money will flow into your bank account. How much? you made a gain of 4.2. And of this gain of 4.2, the realized portion is actually 0.84. Okay? Then the balance will be the unrealized portion that was already carried or recorded in the books much earlier. Okay? So what we need to do now is that we need to offset from the carrying amount of the forward contract. So this one, 3.36, we need to offset from the carrying amount here. So this one, earlier, when we capture it as part of the unrealized, we debit. So now we credit. We credit. Okay? And then of the other set of entry, which is the OCI here, we are also going to do some recycling. Okay? Because of this particular analysis, we know that this one already offsetted from the forward contract. So, which means this particular component is now something that we need to offset. How do we offset this? Because we have to put it in the OCI because it was unrealized then. So now, since the forward contract has already matured, you have already settled net in cash, which means this 3.36 is now a realized profit. So you offset from the OCI. That means you need to debit the OCI. You debit the OCI, and then now you can credit to the profit or loss. So this is a realized profit of 3.36. This is what we call recycling. Recycling, because you remove it from the unrealized profit to the realized profit. So once you credit to the profit or loss, this is a realized profit. Similarly with this one here, because you pass the entry to the profit or loss, this is a realized profit. You pass the credit entry to the profit or loss, this is also a realized profit. So in other words, recycling means that you are recognizing, you are transferring the amount previously recognized in the OCI to the profit or loss. Okay, and now this is a realized profit, which means that you have money, real money that is in your bank account. Okay, so like I say, since you have to buy the jet fuel at a much more expensive price today, which is at 2.19, so how do we compare if we don't enter into the forward contract and we did enter into the forward contract? So this will be the analysis. So they tell you, what is the overall effect on the profit or loss? Remember, you paid so much. This is 30 million gallons at what price? 2.19. At 2.19. This is how much you paid. All right, so you paid 65.7. Then you also have to take into account the offset. Okay, because remember the H item was 2.04. So which means for the H item, you actually pay much more. So the H item was a loss scenario. But this is the H instrument, forward contract. Forward contract, you settle net in cash, you made a gain of the addition of these two, which is 4.2. You understand what I mean or not? Okay, so which means one loss, one gain. They move in the opposite direction. Only then you can offset ma. So in other words, because you entered into a forward contract for this particular purchase of 30 million gallons of jet fuel, your net cash outflow is 61.50. But if you didn't enter into some hedging instrument, of course, today you need to buy at the spot rate. Today you also need 65.7 million. So of course, compare these two, you are in a better condition. You are in a better situation because you made the right decision to enter into some derivative contract. Understand? So sometimes it may go the other way around. So it depends. So like I say, just because the hedging instruments are always very low entry cost, it doesn't mean that every time you have to enter into such instrument. Okay, so you have to do your homework well enough and do your speculation well enough. Okay, so this one is just the summary which we have already gone through. All right, so with this particular slide, yeah, I would have finished the financial instrument with you. All right, so the next week's class, the next 2 weeks class will be handled by Miss Lim again. She will continue on to finish off whatever syllabus there is for the SBR. And then your IRC class with me will start on the 26th of October. All right, 26th of October is your IRC class number 1. Okay, so you just take note lah. And then of course, since we are very busy now marking the undergraduates exam scripts, as I mentioned earlier today, I will try to finish off the marking first, and then we'll come and review your answers for the progress test and give you the feedback by Tuesday or Wednesday. Okay? All right. Any questions so far? Any questions? No, Okay. So if no questions, I will see you again on the 26th of October. Okay? All right. See you. Bye-bye. You may leave the class now.